here. And joining me now with more is Michael Renking. He is the senior market strategist here for the NYSE. Michael, it's great to have you in studio.
Morning. Thanks for having me.
All right, a lot of action to unpack. Yes. Where should we start?
Yeah, Federal Reserve. I think that's the obvious place to go, right? And there was probably a lot of drama behind closed doors yesterday. I joked that, with one of the NYSE's newest IPOs, StubHub, if they had actually been selling some tickets to be a fly on the wall in that room, I would have definitely paid a premium. But in the aftermath of some of the drama that likely occurred, right, we had a pretty non-dramatic, kind of press conference and kind of statement from the Federal Reserve. They cut rates by 25 basis points, which was widely expected. We did see kind of the committee kind of highlight, which Chair Powell did during Jackson Hole, that kind of the balance of risks had shifted in the labor market, right? And and Chair Powell kind of suggested that even the balance of risks on the inflation side, which we're still tilted to the upside, may have moderated a bit. So kind of at the end of the day, kind of as expected, I think the biggest surprise for me, at least, and I think for much of the street, was that we only had one dissenter, being Stephen Moran, who was just added to the Board of Governors, on Monday, and kind of very closely aligned with the White House. But the previous dissenters, Waller and Bowman, kind of fell in line, kind of voting for this 25 basis point cut. We had talked about in our note yesterday that some of that might be related to. And it was kind of teased by the Wall Street Journal's Nick Timiraos, that if if members of the committee don't kind of fall in line and vote along with kind of the rest of the board, that they don't get to help shape some of the narrative in the statement. And you could definitely see that there was a dovish tilt in the forward guidance that we got yesterday, suggesting that we have more rate cuts to come through the remainder of this year. Markets are pricing in 2 at this point.
So why was the market reaction muted in the wake of this decision?
Well, look, I think, a part of that is just what we've seen going into it, right? We've had, we're hitting consistent new all-time highs. We had Treasury yields have moved, kind of 20, 30 basis points, kind of off of recent levels, right? So we've rallied pretty significantly, kind of into that move. I think there was this hope, right, that you would, kind of get a really, really dovish pivot by the chairman. And he pretty much, it was much more of the same, right? And he, he said, we're in a difficult environment. You could see within the dot plot that there are kind of a wide range of views, kind of on the committee in terms of where, they think rates are going to be this year and next. If you look at next year, so this year the dots moved down, showing 2 additional cuts through the remainder of this year. But we're only seeing, kind of in the median dot, 1 cut for next year. But the range of expectations, falls between 2.5% and 4%, kind of for where rates will be at the end of next year. So, given the environment, there's a lot of uncertainty, and I think, we need to see things evolve. And Chair Powell, instead of just kind of telling you we're on a preset course of cutting, he once again maintained optionality, saying, we're going to be data dependent on a go-forward basis.
I do want to talk about the economic data, because we have seen some pretty significant downward revisions to the jobs picture in the past 18 months or so, at least for the data that we saw toward the end of March. Those revisions by 911,000, plus the regular data that does come in on a weekly basis, with claims and monthly basis too. And so what is this telling us about the path forward for the economy as jobs are showing signs of lessening and inflation is looking sticky?
Yeah, so we're in this very interesting environment, and it's really become a balancing act for the Federal Reserve, right? Because as you pointed out, right, we are seeing kind of the labor side of the equation show signs of weakening, right? And it's a difficult situation where we're seeing both the supply and the demand side, kind of shifting there with some of the immigration policy. So we're trying to figure out kind of where that break-even kind of job creation level is for markets. Yesterday, Chair Powell acknowledged the fact that we had these big negative revisions, but also pointed out that they were kind of largely in line with what they were kind of projecting, which makes some sense because, Wall Street economists were also kind of pretty much, they were also in line with where Wall Street economists were. Now, in terms of claims, last week was interesting because we saw a very big jump in claims, which was, added to some of the concern about the labor market. We had talked about in our notes that, there was a lot of that was driven by Texas, We were questioning whether some of that was related, to kind of the season, the end of the kind of the summer season, or what was driving that. But given Texas has become such an important part of the economy and a driver of economic growth over the last year, that was a little bit concerning. We did see this morning's numbers have kind of backed off. So we went from 264,000 back to 230,000, in terms of claims, right? So it continues to kind of suggest that we're in this economic backdrop that, that the labor market is clearly slowed, right? But we're still seeing a decent amount of economic activity. If we see a series of rate cuts, right, that could start to spark some demand in the housing markets and some of those more interest rate sensitive areas of the the economy, and that could help kind of increase activity as we move forward.
Michael's going to join us again after the market opens to break down, of course, the path forward for equities. Michael Ranking, Senior Market Strategist for the NYSE. Thanks so much for joining.
See you in a little bit.
Yep, see you soon. All right.